All right. Hi, everybody. Welcome to the stream. Let me just get things set up here. Give me a quick little minute. Hopefully I can get the chat going here as well. So I think I've got it here. So this is the chat. I'm just going to pop this out and then maybe bring it over here so that I can see what you're doing, see what you're saying. How's everybody doing today? Hopefully you can hear me loud and clear. Hopefully you can see me loud and clear. We've got a little visitor with us today. So I've got Irie. I kind of shifted my webcam angle just so that we can keep her in the corner here. I don't know how long she's going to stay with us, but let's let her. I'll let her stay here as long as she wants to stay. So hopefully everything is going according to plan. Oh, yeah. Great. Everything looks good. And hopefully you're here and good to go. Awesome. So let me just get this guy. And let's break right into it. So I'm not going to have any guests tonight. I'm kind of waiting for a special cable to come in the mail. Last time I tried having a guest over Skype and just the audio was just awful. So I've got a special cable coming in. Hopefully that means that next week I'll be able to have Daryl back on. I had mentioned, I'd kind of joked about having my dad back on, or having my dad as a guest, and a lot of people loved that. So I'm going to see if I can hook that up. And then also considering doing a little episode on impact investments. I think that there are a lot of people right now looking for ways to be able to have a real impact. And I think that that could just be like a really cool sort of show on its own. So for tonight, it's just me. You've got me and my dog here. And really, I'm just going to go through and answer your questions. It's been another sort of roller coaster week in the markets. We can take a look at the Canadian market, the TSX, and just over the last 5 days, you can see that basically Friday, pretty flat, ended down a little bit. We had a nice little bump up, and then, it's just been a bit of a roller coaster. So today, things did rebound a little bit. The other thing that I'm keeping my eye on that I think a lot of people, we had kind of mentioned it last time, is this idea of the Volatility Index. So if we look at it over the last 6 months, you can see it was nice and stable, and then kind of this peak volatility, and really kind of peaked mid-March, that's when things were really probably the most chaotic. And you can see that the market is starting to calm down a little bit. So we'll see. I don't want to get my hopes up too much. The sense that I get is that from the biology side, that really the next 2 weeks are going to be absolutely crucial in terms of getting this thing under control. And that really I am committed to doing these YouTube live sessions every week. I think I'm going to stay at this sort of Thursday at 7 p.m. time slot, and really to get us through this. My hope is that we're going to have some good news, that we're going to be getting this thing under control, that we are sort of flattening the curve, but obviously we're going to be keeping our eye on things. The other thing I wanted to say sort of right off the bat, somebody sort of wrote in with the comment of, just really sending a lot of love to people who are really affected by this, that have lost their jobs, that have lost their income, that are really struggling to figure out what the heck they're going to be doing. To be in a position where we can even be talking about investments at a critical time like this means that we've got some privilege, that we're okay, that we've got our emergency funds, that we've got cash in the bank, that we're going to get through this. So, just want to sort of send a bit of love and compassion and empathy to people who are really being hit by this a lot harder than certainly I am, and that likely that, being hit harder than we are. If you're listening to this, you're probably doing a little bit better than the average person right now. So sending some love there. Really in line with that, a lot of Canadians right now keeping their eye on the price of oil. So really interesting development today. Trump tweeted, a tweet from Trump saying that, he's personally called the king of Saudi Arabia, the royal prince there. And so, really a little bit of optimism that they might get a deal between Saudi Arabia and Russia. At this point, I'm saying it's all rumors. I really don't know what's going to happen, but it did cause the price of oil to jump back up just a little bit. This is sort of the real-time price. So if we look at where it was at the start of the day, about 20 bucks a barrel, now it's at about 25 bucks a barrel. If we look at the West Canadian Select, so this is in Alberta, it really bottomed out at about $4.25 per barrel of Western Canadian Select crude oil, and it is now up to about 8 bucks a barrel. So, really we'll see how this goes. This is something I'm going to be following over the next few days. But really the goal for today is I'm just going to go through questions. So I got a bunch of questions that people had emailed me hoping to cover for this. If you have questions, please put them in the chat. I'll go through them. I'll stick around as long as people sort of have questions. But I will kind of start with the ones that have been emailed in. And then please know that if you do put some questions in there, then I'll be sure to get to them. So right off the bat. Okay, so Drew, and I see you're right here. You're a punctual man. You're right on this. So basically, you sent me a good email. I think it's a great question. Basically, how do I keep money in the Toronto Stock Exchange, so in the Canadian economy, and avoid oil, as well as buffer myself against a potential slow Canadian economy in the future, including a recession? Currently I have some of my portfolio in HEWB. This is going to be an ETF that is equal weighted Canadian banks, as I needed to increase financials and Canadian exposure in my portfolio. So now I'm very confused about how to invest in the Canadian market and financial sector and stay away from oil if our economy is going to really struggle. I am unclear what percentage of Canadian I should have, and if there are better Canadian financial institutions to invest in, or how to navigate international financial institutions with foreign withholding tax. Okay, so let me address the foreign withholding tax piece right away. Don't stress about foreign withholding tax. Really the only way this applies is if you were to hold US dollar securities inside your TFSA. Really that's the only problem. It's an issue. You would get dinged with the tax if you hold US dollar securities inside of an unregistered account. You'll pay the tax, but then because it's unregistered, they would actually count that towards your taxes. So you'd be paying the taxes, the foreign withholding tax, but then at tax time you'd be declaring that you paid your tax. That would lower your overall tax bill. So really the only issue you've got, Drew, the only issue you've got is if you're dead set on holding US dollar securities inside of a TFSA. If it's inside an RSP or if it's inside an unregistered account, then it's really not a big deal. You don't have to worry about them at all. From there, what I want to do is address this idea of how do we invest in the Canadian economy, as well as buffer myself against a potential slow Canadian economy in the future, including a recession. So, I think what you're speaking to is that if we look at the TSX 60, which is, I believe, XIU ETF. I think this is the TSX 60 ETF, right? So here it is. This is just like the 60 largest companies in the Toronto Stock Exchange. You can see here that it's really dominated by banks and by energy. And this energy, again, is going to be oil and gas and pipelines is kind of what counts in there. So, really what you're saying is, hey, I'm okay with this, I think is the sense that you get. Probably okay with some of these other things as well, but really we don't want to invest in a fund that has such heavy exposure to energy. So what you're going to want to do here is to look at Canadian sector ETFs. And I'll do it through BlackRock or iShares just because they probably have the largest selection of different ETFs here. So what I'm going to do is I'm just going to go to the BlackRock website. Look at this, all this sustainability. Oh, this makes me so happy. All this sustainable investment stuff. Let me just see if I want to see if there's a menu here. And I want to see if we can get a list of their ETFs. Here we go. And then from there, what I'm going to do here is we're going to look at equity and we're going to look at Canada and we're going to look at the different ETFs. So there are 23 different ones. The TSX 60 and the Composite Index, these are going to be the very broad ones. But then from there, you can see that they do have different sector ETFs. So this would be an alternative to the one that you've got. This would be just Canadian banks and insurance companies. I don't care so much about these high dividend or dividend aristocrats. Those will probably have lots of pipelines in there, would be my guess. Here's the energy. So XEG, this is the one that we would want to avoid. But look, here's XIT. This is the TSX capped tech ETF, right? Here's a utilities ETF. This is going to be a capped consumer staples, bank and life co, capped materials, right? These are really all going to be all the different Canadian sector ETFs. So you can see here Canadian tech, probably not a huge issue with this. You know, Shopify, I love Shopify, great company. I would say that this is not going to be very good. Oh, I'm seeing here, Rick, clarity of the video is not great. So one thing you can do, I should be streaming in high def now, but it's going to be limited by your connection. But there should be a little link on YouTube where you might be able to select the quality. And what you can do there is sometimes it's defaulted to a lower quality. And hopefully, I think it's the little like wheel and the settings, and that, you know, hopefully you should be able to have a little bit higher quality there. So it looks like it's clear for other people, but Rick, hopefully you can sort that out. So, you know, you can see here Shopify is like 30% of this ETF. So, you know, I want to be clear, there's going to be a bit of a tension here. Is it worth doing ETFs, or should you just buy the companies individually? You know, there's going to be a little debate there. Of course, I always like the ETFs, but this is a circumstance with the market the way that it is, where you might move a little bit more towards individual companies. I don't know. Again, I would prefer the ETFs. I'm getting news from my producer here that, yeah, there's a little cog in the bottom right corner, Rick. So if you see the little cog, and it should be able to improve the quality of the video. From there, you can see, you know, Constellation Software, CGI Inc. I don't know enough about these companies. OpenText, I would need to do a little bit more digging into them. But really, I would suggest that, you know, this would be an interesting place to start, would be looking at Canadian tech. As well, here we've got Canadian utilities. So when we look at what's in here, you know, Fortis, Brookfield Infrastructure, Emera, Algonquin Power Utilities, oh, Hydro One, look at that. You know, here's Brookfield Renewable Partners, one of my favorites, Northland Power. Now, there are going to be some natural gas in here. This is not just renewable energy. So you're going to have some AltaGas in here, you know, TransAlta, which last time I checked, they did have coal. So TransAlta Renewables, they kind of spun off a lot of their wind and some of the natural gas in Australia, but TransAlta, I think, does have coal, maybe Capital Power as well. So, you know, this might not exactly be fossil fuel free, but again, this is going to be a bit of a more defensive sector right now. From there, this is going to be consumer staples. So again, you know, staples, these are things that people are going to keep buying even during a recession. So again, a lot of good ideas here. You know, these are going to be grocery stores, Metro, Alimentation Couche-Tard. So this is, you know, convenience stores. We've got Loblaws, Saputo, George Weston, you know. So these are going to be, again, companies probably a little more defensive, all Canadian. You know, it's going to be up to you whether you want to pick and choose the companies or whether you'd rather do the ETFs. But this is basically, if we want to avoid energy sector in Canada, really what we would do is do these sector ETFs to avoid energy, but still have a nice diversified Canadian position. Bank and life co. So the other thing, you've got a lot of the banks, but I wonder if you've got exposure to the insurance companies. So, you know, if we look at what's in here, again, there are going to be, you know, here's Manulife, Sun Life. So, you know, you might consider doing, looking at a little bit more on the insurance side of things rather than just the banks. And then materials, you know, I don't love these. This is going to be a lot of the mining companies. So Barrick Gold, Franco-Nevada, Nutrien. Oh, hi, Irie. Okay, give me one moment. Let me just let her out, and I'll be right back. Hey. All right, dog problems. Here we go. So, oh, and here she comes right back in. So I think she might be here to annoy me. So give me a moment here. It's always fun with these webcams right now, right? I think we're learning about everyone's kids, learning about everyone's pets. Let me just close the door. Okay, come on, catch, come on. There we go. All right, good girl. Here we go. There we go. Okay, you be quiet. So, again, I don't really love this this materials sector that much. That said, there could be some good Canadian names here, things that you are personally comfortable with. Okay, so let me just see here. Thanks, Keely. Oh, yeah, default 144, much better now. Fantastic, Rick. Happy to get you sorted out. Okay, Gail here asking me, should I choose more weight to Canadian than my previous allocation due to COVID? I don't think so. I don't think there's any need to go overweight Canadian at this point. But this would just be, really, and why don't I address the question of how much Canadian you should have? So there are different schools of thoughts when it comes to this question. Really what I tend to follow is this standard benchmark, which is the All Country World Index. You'll often hear me say this is the one ETF to rule them all, because this is the entire global stock market in a single fund. From there, we can look at the exposure breakdown. Here it is. And you can see that Canada is in here at about 3%. So straight up, my assessment here is that if we're trying to mimic the global stock market, you really only need about 3% exposure to the Canadian market. That's it. Now, obviously, some people like to have quite a bit higher. Like if you look at a lot of these, what are they? The couch potato portfolios, or the very standard model, they'll often have something called a home bias. When it comes to Investopedia, here we go. When it comes to a home bias, this is a really, really common thing where basically everyone, when it comes to their home country, tends to invest a much higher percentage in their home country, right? What they're doing here is investing in domestic equities, ignoring the benefits of diversifying into foreign equities. Sometimes there are some issues. We don't really have those here in Canada. Really what we're trying to do here is look at, really I would say the argument for home bias is the fear that if we have inflation here in Canada, but we don't have inflation in the rest of the world, right? So let's say we have inflation, the value of the Canadian dollar drops relative to all other currencies. In that case, it would, because you're planning to retire in Canadian dollars, you really want to make sure that you've got exposure to that Canadian dollar inflation in order to have enough money in retirement. Now, the scenario where this would be important is if we had a lot of inflation here in Canada, but they didn't have inflation in the US. Right? Where the Canadian dollar got a lot weaker compared to the US dollar, that's where a home bias would be really important. My personal perspective is I'm not really worried about that. I feel that our economies are so linked that it's hard for me to imagine a scenario where Canada experiences rapid inflation and the US doesn't. Now, it could happen. We're in these unprecedented times, so that would be the argument for home bias. But I want to be clear that, I would say that your Canadian exposure, really doesn't need to be that high. At most, it would be about a third of your equities. So let's say you did a nice sort of 60-40 portfolio. If we look at my economist.com, if we look at my model portfolios, I always do these 60-40. And again, these are models. So this isn't for everyone, but this is just like the standard thing that I use for the internet is like a 60-40 portfolio. And so you can see here, this would be a portfolio with a home bias where we've got 15% of the overall portfolio. So that would be about 25% of your equities because we have 60% equities. So 15 out of 60 is 25, but 15 of the entire portfolio here in Canada. This would be, I would say, at the high end of what somebody should have if they really want that home bias. Whereas the low end, if I'm clear, and kind of what I would suggest is this 3% that we've got in the All Country World Index. So if you only have 3% in Canada, I'm okay with that as long as you are very heavily diversified. That said, if you're worried about inflation here and you wanted that home bias, then I would let you go up to about 15% of the total portfolio or 25% just of your equities to invest in Canadian equities. Does that make sense? Hopefully that's clear. There's a big debate about whether a home bias is a good idea or not. Personally, I don't necessarily feel that I need a home bias, but there are many reasons why somebody would want that home bias. So thanks, Tim. Appreciate the answers. Yes. Is it safe to assume that Canadian banks will follow whatever the energy sector does as they are so heavily invested in them? In the coming months, that Canadian banks do have really heavy exposure to energy assets. This is why I'm keeping my eye on it. And that obviously this is the way energy goes, that's gonna have a big impact on Canada's GDP. But what I would say is that, really it's a bit of an indirect, it's not necessarily a one-to-one that as energy goes, so will Canadian banks. It's more that as energy goes, so will the Canadian economy. As the Canadian economy goes, so will the banks. So this is why I am a little bit, I would say, bearish on them. I'm very sort of concerned. Part of the problem is that there has been some really cool work done by, I know, like Rainforest Action Network. Here it is, Banking on Climate Change, this report. So this is from last year. And so this looked at different banks, and that we can see what they're doing here. And specifically when we look at tar sands, where is, here we go, Bank of Montreal, D-, RBC D+, Scotia D-, TD D+, right? So they all have pretty heavy exposure there. And so I would be a little bit cautious about them. Okay, cool. Gail here, concerns about REITs now given issues being able to pay for rent. So yeah, I think that I do have some concerns around the real estate sector. So what's the Canadian real estate ETF? I forget the ticker symbol. It's going to be, where is it? Here it is, XRE. This is a pretty good one. So, they've been hit really hard year to date. You can see real estate is considered to be cyclical. So I would expect this to be hit pretty hard. Really, again, it is going to come down to individual companies. Personally, I feel less concerned about real estate, although there is a possibility of something like a rent strike or something like that. I think it's low risk. It could happen. What I'm really, really worried about is commercial real estate. And you can see here that if we look at the breakdown of this ETF, residential REITs, retail REITs, this is what I'm really worried about. That to me, retail space is getting nailed. And I don't know what's going to happen there, but I'm expecting that a lot of consumers are going to shift to online only. That, it wouldn't surprise me if that is sort of the dominant, one of the big shifts that does come out of this. As well with office REITs, it'll be fascinating to see whether this whole are people actually going to continue working from home, or are they going to go back to that like 90-minute commute? I just really have no idea. So I'm cautious about real estate right now. I would say that I feel a little bit better about residential or industrial or even healthcare. Where I'm really feeling cautious right now is retail and office. That I don't know how that's going to play out. So again, real estate would often be a place for Canadian investors to look to invest in the Canadian market. Right now, I would just say I would be a little bit cautious that I'm not so sure that these commercial real estates are going to come back in the way that to where they were. Okay, so let me go back. Let me just make sure that I did get your entire question here. So yeah, in terms of keeping money in the TSX, look at those individual sector ETFs. Also, really look at it. I would much prefer to look at the sort of the ETFs, but you might consider doing some individual companies if you did want to go in that direction. Hopefully that is helpful. Okay, so Rosina here, she had sent me a message. How can you measure the climate impact of traditional investments? And then does changing my personal investments really make a difference? Or do we need to join divestment movements for real change? So let me address the first question, just because this is, I think, a bit of an easier answer for me. I know where to find that data. The second question is a little more philosophic, so we can talk about that. So really what I want to do is the resource that I use is Morningstar. So morningstar.ca, the Canadian version here, ESG research provider. And whereas we can get the individual company ESG scores on Yahoo Finance, I think what's super cool is I can look for it on Morningstar. I can click on this portfolio tab, and after it loads, let people at Station Cold Brew, thank you for keeping me well caffeinated. So you can see here when it comes to these ETFs, look at this in Morningstar, I get these carbon metrics. And this to me is just so awesome that I get this data available for free through Morningstar. So you can see here, it gives me the carbon risk score. So this is a number between 0 and 100. A lower score is better. And it's the asset weighted sum of the carbon risk scores of its holdings averaged over the trailing 12 months. So really what they're doing here, it's an evaluation by Sustainalytics, and it's the degree to which the firm's activities and products are aligned with the transition to a low carbon economy. It looks at things like carbon intensity, fossil fuel involvement, stranded assets exposure, mitigation strategies, and green product solutions. So I've never seen any company like up here. To me, this is a pretty high score, 9.32. You can see here this dotted line, 8.84, that's going to be the category average. So in this category, this is going to be global equity, right? Or I guess they call it here, world large stock, great? So, this is the average. You can see that this ETF is slightly above average on the carbon risk score. This fossil fuel involvement percentage, this is going to be basically how much exposure to fossil fuels it has. They define this as thermal coal extraction, thermal coal power generation, oil and gas production, oil and gas power generation, and oil and gas products and services. So you can see that the All Country World Index, if you were to invest in that ETF, you've got like 11.5% of your money is very heavily exposed to that carbon bubble. That's big. So what this tool lets me do is to look at different ETFs, to look at different funds. I can do mutual funds on here or ETFs. For whatever reason, they don't have bonds. The bond scores are little. I don't get the bond scores. And certain ETFs, I don't get all of this data. But my starting point, regardless of the ETF, is always to look up on Morningstar, to look up the fund, click that portfolio tab, see if I can get these Morningstar carbon metrics. And that's what's going to tell me what the exposure to carbon is for that specific fund. So hopefully that answered the first question, which is how to measure the climate impact of traditional investments. That's how someone can at least measure their own personal exposure. From there, does changing my personal investments really make a difference? So as far as I'm concerned, yeah, it's going to make a huge difference to your retirement. That, I look at this from two lenses. There's the ethical argument, and then there's the financial argument. The financial argument that I'm making is that I think that fossil fuels are going away. And we can talk about the timeline there. It's not going to happen overnight. But if I'm looking at this, I'm 38 years old, right? That it's going to be, actually I'm 37 now. Geez, I'm going to be 38 in December. But that, I've got a long-term horizon. And if I'm looking at this over the next 30 years, I really think that fossil fuels are going to turn out to be a pretty darn bad investment. Now, it could be at this moment in time that fossil fuels are at a low, right? So it might go back up from where they are right now. That wouldn't surprise me. But long term, I do think that we're shifting towards a greener economy. So, for me, I looked at the impact from my personal retirement, and I think it's quite huge. Now, in terms of the ethical argument, a lot of different ways to look at this, right? And I totally understand this feeling that when it comes to the secondary market, right, when it comes to the stock market, when I'm selling my shares, someone else is buying them. So it's not like those shares disappear. However, this really speaks to this idea of Adam Smith's The Invisible Hand. So this is a very, very famous economic theory. And it's very similar to the analogy, if you've ever heard of, the story of someone walking down the beach, and there are all these starfish on the beach, and someone's like picking up a starfish and throw it in the ocean, right? And the little kid's like, oh, well, it doesn't matter to all these different starfish. And the person picks it up and is like, well, it matters to this one. The idea is that as a collective, if everybody takes a small move, that's how we get systems-wide change. And this is the idea when it comes to supply and demand with the market mechanism, that what we're doing is by divesting from fossil fuels, we are reducing the demand for oil stocks. What that's doing is putting downward pressure, because no one's buying them, puts downward pressure on the price. That impacts the company's cost of capital. We're seeing this play out right now, where a lot of these oil companies are in trouble, and they're having a really, really hard time raising money in the market right now, in large part due to divestment movement and what I would call a negative preference for oil, that people don't want to buy oil stocks right now. So, there is talk of like a bailout of the oil sector in Canada, which would make me so angry and so upset, but that could happen, right? And one of the reasons that could happen is because the private market is no longer stepping in, private investors are no longer stepping in. So my response to this is, does it make a difference? Yes. Now, does my personal little TFSA make a difference? Maybe not, but the more people do this, the more of an impact that's going to have. And certainly by telling other people that you've done it and that, hey, maybe this has been a good financial decision for you because you missed out on the oil crash, that hopefully more people will do it. And do we need to join divestment movements for real change? Like, hell yeah. Like, I'm a big believer in diversity of tactics, that we need as many tactics as we can possibly have. Divestment is one of them, but we need other movements as well. We need to get the big investors like the pensions and foundations and endowments, we need them to divest. We also need climate action from governments and from all levels of government, federal, provincial, municipal, right? We need corporations on board with this. So when companies are like going greener and investing in renewable energies, fantastic. We need to approach this from all different angles. And that I will give a quick little shout out to shiftaction.ca. Oops. I believe that's the URL. So this is a shift action for pension wealth and planet health. And this is an advocacy organization that is trying to get pension funds to manage their carbon risk, which to me, this is awesome. So this is, certainly I think you should, do it with your own money and be part of that solution. In addition, you can take action now to be able to understand how Canada's pension funds are dealing with this, and ideally advocate for them to, number one, lower their fossil fuel exposure, and in a perfect world, to number two, they would actually divest and then reinvest in some of the greener solutions. So this is a really cool way to go kind of above and beyond. We do need systemic risk as well as individual action. Perfect, seeing here, everyone doing their part to help the green economy can be done, just like everyone social distancing. Yeah, I mean, I think it's an interesting point, Drew, like really this idea of collective action, that, when everyone is on board, it's amazing what an impact this can have. So I'm really, really hoping to be able to shift things in this direction. I do see another question here from Onana, I believe. How do I like ZGI from BMO? So I don't know this one off the top of my head, so give me a second here to look it up. So this is going to be, is it ZGI or is it ZIG? I know about ZIG. Let me just see. Oh, accept. Okay, no ETFs. ZGI. Oh, no, it probably is ZGI. Global infrastructure. Okay, this is interesting. I don't know this one so well, so this would be a global fund. There's going to be a lot of pipelines in here. There's so much pipelines in here. I really don't like this. Let's look it up on Morningstar. ZGI. but this is probably going to have a very, very high carbon risk score. So let's just take a quick look at it here. So yeah, look at this, carbon risk score 18, fossil fuel involvement 56%. So I would be really, really cautious when it comes to this. Pipelines are in a funny time right now where they're doing better than oil companies, right? Basically, oil shipped by rail is now, it can't happen. Shipping it by rail is more expensive than the oil itself right now. So no one's going to ship by rail. I think pipelines will be okay through this. But again, if we're talking about a 10-year, 20-year, 30-year horizon where we are shifting towards a green economy, I would be really, really cautious about investing in an infrastructure ETF that has massive exposure to these pipelines. Yeah, I would really, really be careful with this. In my mind, if you wanted something like this, right, if we wanted the alternative, let me just go back to Yahoo here. So ZGI, right, just to show you sort of what's up, that it would have a nice dividend yield of 3%, right? But when we look at it over the last year, you can see really impacted by the oil crash. And so really you are betting on sort of Saudi Arabia and Russia getting their act together and getting that oil price back up. I'm just not confident of that. If you wanted something like this, it's not available in Canadian dollars, but there is this YLCO, which is the Co ETF. So this is going to be Renewable Energy Income ETF, where it's got a lot of these utilities. Now you can see it has maybe a bit more of a roller coaster, but it's got a very, very similar yield, right? And I'm just curious, I just want to chart it. And I just want to see if I can show it. Yield Co, and I'm going to compare it to ZGI.to. And I'll make this one. And that, if we were to look at it over the last 2 years, you can see they do follow fairly closely over the last 5 years. This is interesting. I'm not sure with YieldCo. I think there were a bunch of these YieldCos did do poorly in 2015. But if we just kind of take that decline out of it, here we go, then you can see that they do perform very, very similarly. YieldCo does seem to be a little bit more volatile, up in the good times, down further in the down times, but then it did bounce back a lot higher. But to me, this is something that I would much, much prefer to ZGI. Hopefully that helps. Okay, let's see here. Brookfield just announced the issue of $350 million in green bonds. It is about time. Do I have any key tips for measuring the value or credit of bonds in this space? Not really. Brookfield Renewable Energy Partners. So this would be one of my renewable energy utilities that I really like. This would be another way to get exposure in terms of Canada. So if we look at it, it's one of the largest ones, $10 billion, and such a nice yield right now, 5.36%. It has come down, right? If we look at the share price, it has dropped quite a bit, but that means that the dividend is higher. That if you bought it when it was at up here, your dividend percentage would have been much lower. So this is one of these, if you did want a nice big dividend exposure to Canadian, but renewable energy utility, this would be a decent option. I'm thrilled that they just announced bonds. This is the news release. Not an April Fool's joke. It looks like they're announcing this. So, I would be cautious when it comes to buying individual bonds. Steve, I have no idea how to value these. And what I would say is that generally these things do get oversubscribed, which means that there's more demand than there is supply, which means that unless you bought it right away, like the IPO, you're probably buying it at a premium. So if you can get your hands on these, awesome. I don't know if you'll be able to as an individual investor. Normally they do get snapped up right away. And I would be cautious about paying a premium for this type of green bond. From there, what place should corporate green bonds like this have on the fixed income size of a sustainable portfolio? So, it's tricky. I would be really, really cautious. So what we would do is do something like, what is it? GRNB. So this is like a green bond ETF. So, I mean, to me, it's like I would much rather have an ETF, but like the yield on this is very low. When we look at what's inside of it, it's going to have a lot of international. I don't know if it's going to tell me. I can just show you here a few of these things. Federal National Mortgage, this is US. European Investment Bank, Chile. KfW is German. Bank of America. So it would end up in an ETF like this. For me personally, this should be a very small part of your portfolio. Most of my bonds I do want to keep in Canadian dollars. The reason I want the Canadian dollars is because when it comes to our bonds, I want very, very low risk. And when we look at something like the Green Bond ETF, it's going to have currency risk. That if we look at it, it just fluctuates a little bit more than I would like based on currency. As well, since this is in US dollars, we have to convert everything to Canadian. The reason we want bonds is for low risk. By having US dollar bonds, that means that you've now added currency risk into the equation, which, that currency risk could just wipe out any of your gains from the bonds. It's a bit of a coin toss there. So to me, I don't feel like this is a necessary part of a sustainable portfolio. If you did want to add this into the mix, I would limit it, no more than like 5%, 10% max of your overall portfolio. And obviously, I would want this in conjunction with another bond ETF. Hopefully that answers your question. But really, in terms of bonds, for the fixed income side, does depend on your risk. And yeah. Okay, great. Yeah, I forgot about the oil, like the performance, but past performances, yeah, I agree. Renewables way to go. I'm in there. So just be aware, BAM. So this is Brookfield Asset Management. Brookfield's a little bit funny. This is BAM. There's going to be BAM.to. This is more their asset management. This is more like the bank, right? From there, what I'm talking about, just to show you the comparison here. Oops. What I'm talking about is BEP, which is Brookfield Renewable Energy Partners. I'll make this the green one because it's the green one. You can see that it did underperform for a little while, but it's held up so much more than the asset management division. Brookfield also has a property division. What is it? BIP, I think. Yeah, here it is. Oh, this is infrastructure. Right, so I'm just curious there. Okay, this one's held up okay. And then, yeah, I don't know the real estate one off the top of my head. But, so to me, I would really prefer this renewable energy to the Brookfield Asset Management. Although, if it has come down here again with a lot of the banks, they might bounce back up. It's hard to know exactly. Okay, from there, that actually dovetails nicely into the next question from Matthew. And asking what groups in Canada sell green bonds. So obviously Brookfield just did this green bond issuance. I don't know if we're going to be able to get access to that as individuals. It's kind of annoying to buy individual bonds. You have to call up a bond desk. There's usually more of a transaction cost. They're not as liquid. So I really don't like buying individual bonds. Really the only group here that sells bonds, green bonds in Canada, is Co, which I think we've discussed before. I love Co. They do green bonds. Unfortunately, they did just sell out. They did a $5 million issuance and it went super quick. So, I think we will probably have another talk. I think I want to do almost a whole episode on impact investing, and green bonds would be a part of this. That said, right now it is a little bit sad that there aren't a huge number of green bond options available. Co really is my go-to. If you're in Ontario, we do have SolarShare, so solarbonds.ca, that these are available, but unfortunately only available to residents of Ontario. And Matthew, I do know that you are in BC, so unfortunately I don't have an option for you at the moment. But you can see here, if you are in Ontario, $1,000 a bond, 4%. Annual interest rate. There is a little lifetime membership fee. It's a co-op, so just like when you join MEC or something like that, you have to pay $40, and then you get your money back after your 5th year. So, it'll be interesting to see how many they have left. It wouldn't surprise me if these end up getting sold out quite soon as well. I do feel that there is really high demand for green bonds, And you know what I would love to see is the government of Canada issue green bonds. Let's fund this Green New Deal. Let's help fund it. I would totally buy a government of Canada green bond if I knew it was going towards building a renewable energy economy here in Canada. So I'm going to go through a few more questions here. So this is an email I got from Francis, DRFG. So this is the Desjardins fossil fuel free ETF. Seems to have several natural gas holdings, AltaGas, Petronagas, Tokyo Gas, etc. Whereas at first glance it seems the ETHI, this is the Horizons Global Sustainability Leaders, does not. Is that true? Yes, this is true. So when it comes to DRFG, now let's see if Morningstar has updated. Last time I looked up DRFG, I was not able to get the carbon metric score, which drove me a little bit nuts. Yeah, see, it's just not here. It gives me the ESG, but it doesn't give me the carbon score. And so, but it would have some. The reason it's got some is, let me just bring it up. Oops, FG, ETF. So let me just go to the Desjardins website. Is the methodology that they use, you can see it down here. So, the Desjardins RI Global Multi-Factor Fossil Fuel Reserves Free ETF, you can see why I refer to them by their ticker symbol, gives investors the rare opportunity to invest with zero exposure to the traditional energy sector, coal, gas, oil. These are going to be extraction companies, right? What you can see here is that really it excludes all companies in the fossil energy sector or that whole reserve. So these are going to be natural gas, so it's going to get rid of fracking and the extraction companies. But when it comes to electricity generated by it, they only eliminate the utilities that use thermal coal. And the result is that you do get some of these natural gas utilities slipping through their methodology. So it is what it is. I don't love it. I'm not here to defend it, right? Obviously, you know, it gets us most of the way there. My guess is that it would be a very small percentage. I feel like I did get a message from someone. I'm trying to remember. I'm guessing it was on Twitter. Give me a moment here. Let me see if I can dig it up. But somebody sent me an Excel spreadsheet. It was a super, super nerdy thing. I just want to see. Nope. I think it was in my email. Let me just see if I have it here. It was no, that's just going to be the holdings. I might have to dig it up, but basically I can verify that when it comes to DRFG, it does have natural gas, whereas ETHI does not have natural gas. So if natural gas, if these companies are going to be a deal breaker for you, that's when we would shift to like the squeaky clean portfolio. So I've got DRFG as like my easiest pie, and because it is a little bit more diversified, whereas if you wanted to go with ETHI, the Horizons one, this would be part of my squeaky clean portfolio, where because it's not as diversified, you can see here, you know, it has a glaring weakness in its lack of diversification. That's why we do have to sort of fill in the gaps with other portfolios. There are a couple ways of doing it, but one of the easiest ways is to use this MSCI Global Impact ETF, SDG, just because it does a really good job of sort of filling in some of those gaps. So really, you know, my answer here is that, you know, really if the goal is to be totally fossil fuel free, then probably, you know, you'd want to go with ETHI and then either that SDG or a couple of other ETFs, some of those sector ETFs, or we could kind of build around it to be able to have a more a diversified portfolio. I'm just curious with the RBC. Let's just take a quick look and see if I can get it into Morningstar, because I want to see in terms of the methodology that they use, is it actually fossil fuel free according to the good folks at Sustainalytics/Morningstar. Where is it? Portfolio. And then down here. So you can see here, this is the RBC fossil fuel free but not quite. It does have this little 1.03% exposure to fossil fuels, right? And again, it's really hard to get it down to zero. And it likely is some of those natural gas utilities that are going to account for this little percentage. That would be my guess. From there, do I have any suggestions about if, how, when to switch away from RBC because of the high MER or DRGF because of the natural gas holdings? So in terms of the RBC, I'm suggesting that clients really wait for markets to calm down before they before they switch out of any mutual funds. The reason is that it's very annoying. So DRFG, you can switch out right away as long as you know what you're going to buy. You can switch out right away because you can sell DRFG and then right away you can buy ETHI and what other ETFs you're using to sort of fill in the gaps. Because of the way ETFs work, you can sell and then use that cash immediately. Unfortunately, when it comes to mutual funds, there's a little delay that you need to put in the order before 1 p.m. If you put in the order before 1 p.m., then it'll sell at the end of the business day. From there, it'll take 2 to 3 days for the redemption to take place, at which point then you'll have the cash in your account. Now, the reason we would switch out of the RBC one is for the MER, right? The higher fee. And if you look at the higher fee, 2.09, right? And this would compare with DRFG, which is I think 0.69, or it sounds like you might lean towards ETHI, which is about 0.52. So you're going to save about 1.5%, which, hallelujah, yes, I want you to save 1.5% per year. However, it's 1.5% per year. And right now, markets are so volatile that you can see that moved 2%, 2.25% today. And this is like a slow day right now. This is a small move in today's crazy volatile markets. So that 2 or 3 day gap between the time your position sells and the time you're actually able to buy those ETFs, that could be a huge difference. Like last week, remember last week, there was a 3 day period where if we look at it, where it came up from this low, this was like March 23rd, and it came up almost 20% in like 3 days. And my worst case scenario is that you would miss out on a rebound like that. So that's why when it comes to selling mutual funds, I would keep an eye on the VIX, right? This Volatility Index. While that would be a more appropriate time to sell your mutual fund and shift it over into ETFs. Really the fee savings by keeping it in the mutual fund for another month or 2 months or 3 months, not a big deal in terms of that higher fee. The worst case scenario is that you would miss a big bounce back. From there, my portfolio currently has no short-term bond exposure. Back to bonds, only ZMP and ZPL. Should I consider switching it to ZGB or add a short-term bond ETF? So we probably did this because of you didn't want to own federal bonds. Usually I'm like, there's a little question about federal bonds versus provincial bonds. You would have opted for provincial bonds, which is why we did these two. BMO offers a whole bunch of them. So let me just show you what you own right now is the mid-provincial bond ETF. And I'll show you the chart, right? And so bonds have been very steady. So I want to compare this to the All Country World Index. This is over the last 2 years. Our bonds have been nice and steady, whereas our stocks have been very volatile. Now, the other one that you own is ZPL.TO, which is the long-term government bond. I'll make that light blue. You can see that long-term bonds a little more volatile here, right? Not crazy volatile, but more volatile than medium-term bonds. When it comes to short-term bonds, these are going to be incredibly stable. Is there another blue color? Let me do that blue. Let's see. There you go. Very stable, right? So because your time horizon, I would assume that you're investing for decades. Your time horizon would more accurately reflect the time horizon for medium term and long term. So doing that mix is great. Really short-term bonds would be there for you if you really needed the money in the next little while, right? If you were thinking about buying a house or thinking of doing something where you needed the cash, then, we wouldn't want this volatility, right? But the reason we own bonds is because when there's a crash like there was, they've actually gone up in value. Now, they did come back a little bit and they've remained quite steady, but they've performed the way that I would expect bonds to perform. The short-term bond is really going to do basically nothing right now. And if we do look up the yield, ZPS.to, now the term I like is this weighted average yield to maturity. We won't get that here, but we can get this yield. Now, no, that's way too high. That's wrong. So I'm going to have to look it up on BMO. Let me just get it here, because there's no way that that is the actual yield right now. ZPS, which is the short-term bond. I want to look at this weighted average yield to maturity. Here it is, 1.17%. Very, very low. So although it is the most stable, it has a very, very low return. When we look at the medium term, again, a little bit more volatile, ZMP, right? But the yield is going to be a little bit higher. Here's the weighted average yield to maturity, 1.83. And then the longer term bond is going to be the most volatile. It's the one that's going to be the most reactive when it comes to changes in interest rates. But it is likely going to pay the highest weighted average yield to maturity, 2.5. So this is my way of saying that, basically the difference between short term, medium term, long term, really, since your time horizon is likely in the decades, I'm fine owning medium and long term bonds only. That's no problem. Short term bonds, the yield is very low. Really, that would only be suitable if you really needed the cash. I hope that makes sense. Here's the, wow, I wish I had everything in bonds, right? Well, if you had the crystal ball, you would have known to buy bonds, right? But this is why we want to make sure that we do have a diversified portfolio. We always want to make sure to have a mix between stocks and bonds. Okay, so I've got one more question here, so I'll get through this. If there are any other in the chat, we're coming up on 8, so this has been awesome. I'm just going to take a quick little breath here. Give me one moment. I can address your question. Overall, bonds do seem to be flat. Yeah, that's the point. Bonds are the turtle in the race. We are loaning money to the government and corporations. So bonds are debt. The reason we own bonds is because they do have very, very flat profile right now. That's why we own bonds. We're not going to put all of our money in bonds, but we're going to put part of our money in bonds and then use that to rebalance. Keely, I'm happy to go a bit off topic right now. So let's see this. What do I think about the various options to defer payments right now on taxes, mortgages, etc.? Do you foresee a debt problem for individuals down the road? I mean, we have a debt problem right now. We really do. There's a firm that I follow on Twitter. There's a guy, what's his name? Scott Terrio, I think is his name. Let me just get his profile here. Here he is, Scott Terrio. So he works for this company, Hoyes Mikolos. And so this is a company that does bankruptcy protection. So these are debt relief experts, right? Consumer proposals, personal bankruptcy, debt relief. And oh my goodness, following his Twitter account is like an education in how crazy things are right now in the Canadian market. Every day is wilder than the prior one. Some commercial landlords behaving less than ideally out there. So remember, I had some concerns about commercial bonds, or commercial real estate rather. Jobs lost in every possible industry. Businesses worried about their commercial rent. We're advising everybody, homeowners, renters, consumers, business owners, crisis management. So, honestly, Keely, I really, I don't think it's down the road. I think what's the expression? That chickens have come home to roost. That anyone who is overextended during this period, who borrowed money to invest, who borrowed money for rental properties, if you're like a venture capital, a seed stage company that has a runway and your burn rate and you're burning through cash, anyone who took a lot of risk in the last couple of years is in trouble right now. So I do think that this crisis is going to expose cracks in the system, that we are going to see a lot of bankruptcies and we are going to see a lot of businesses go under in the next little while. And I'm really worried about that. I don't have the crystal ball, so I don't know exactly what's going to happen. But, for me, I'm not so worried about this deferral of payments. Really, I'm worried about the debt crisis right now. The consumer debt is very high. So many people living paycheck to paycheck. Again, if you're listening to this live stream or you're watching this on YouTube, you probably have money. You probably have money in the markets. We are going to do so much better than most Canadians. So really want you to look out for your neighbors, your family members, the people that are going to get hit harder by this. But this is why my assessment is that it is going to get worse before it gets better. I think that we are going to drag on really the next 2 weeks, to a month are going to be crisis mode for the next 2 weeks to a month. From there, that's when I think we're going to start to see the other dominoes fall. That people who had been too exposed, I think, that is going to come to light, that really they were taking more risk than they should have. So I do have bigger sort of macro concerns around the level of debt and the unsustainability within our system. That when I look at sustainability, obviously environmental systems and social systems, but the debt aspect in our system has been so unsustainable for so long that I am really worried about that, which is why I did have a little, conversation last week about corporate bonds. I think that could be a bit of a sticky problem down the road. But really what I'm focused on right now is short term, let's get through this crisis, and then we'll start to be able to evaluate the longer term implications. But there are definitely going to be some longer term implications here. Gail, do we think Canadian financials will get some hit due to mortgage issues and credit cards being encouraged to decrease rates? So credit cards decreasing rates, no chance. That's if you've got credit card, that debt is just so bad. I think what we're going to end up seeing is, where was that website from Hoyes? We're going to see a lot more consumer proposals. And I think the banks, I think a lot of people, if they knew what a consumer proposal was, where you don't have to go bankrupt, but this is going to cut your debt in a fraction of what it is right now. If more people knew what a consumer proposal was, this is a legally binding debt settlement agreement to repay your creditors a percentage of what you owe in exchange for full debt forgiveness. I'm worried that the banks are going to be left holding the bag on a lot of this. Consumers have a lot more protections than they realize, and I am a little bit worried about the banks there, but I don't think that credit cards will decrease rate. And I think that Canadian banks are going to be hit by this. I don't know how much, how hard. It's so hard for me to say, but I do think that they might end up being casualties of this, the dominoes starting to fall. I'm really happy that the government implemented these stress tests in 2008, 2009. Coming out of the crash, a lot of the banks had to do these stress tests to be able to see how they would respond to a crisis like this. We're going to start to see how good those stress tests really were. Really, really hoping. Okay, savings account ETFs like PSave over a bond. I went over that a little bit last week, so you can get the YouTube video, my open session window from last week. I did talk a bit about that. I've got no issues with this. Something like PSave or one of these high interest savings ETFs over a bond. I'm super fine with that. I would say an abundance of caution right now. That said, I'm not too worried about government bonds. I'm more worried about corporate bonds. And yeah, isn't there a tax for speculation? Yes, people are paying that tax right now. Absolutely. Okay, I'm going to move on to Vincent questions. So, all right. I've been trying to follow ETHI's daily movement in Yahoo Finance on a few other tracking sites. It often doesn't seem to move at all throughout the day, then suddenly shifts at market close. Any idea why? I know exactly why, Vincent. So the reason is the low volume is what we call. So if we look at ETHI, really the way it's going to work intraday, and I wish the markets were open right now so that I could show you, because this is going to be at close at 347. It's going to give us the date, but notice that this one-day chart is not available. And it could be that nobody bought or sold this ETF all day long. So it just gets the net asset value at closing. So this would be the value of all the underlying securities within the ETF. If we look at the 5-day chart, let me actually go into the chart feature so that I can show you this. Oops, no, I'm trying to get rid of these guys. If we look at the 5-day chart for ETHI, okay, this says, there were a few trades yesterday, there were a couple today. If I look at the 1 day, here we go. See how it looks blank? You're like, Tim, it's blank. Whoa. It's because the volume was 0. Nobody bought anything. So the market I can't tell you what the price is if nobody's buying it. Remember, the way the market works is that it is determined based on transactions. If there are no transactions, there's no price. When we look at the 5-day, this is why, it might not bounce very much intraday in the middle of the day. It really is just giving us, look at the times at the bottom, right? At 3:15, at 3:40, at 12:40, so there was a purchase made. This would signify a purchase. I wonder if it's one of my clients, right? 3:45, end of day, 9:30 a.m. Oh, it looks like somebody bought some right at the beginning, or actually they would have sold some. And then today looks at 3:35. Right at the end of the day, somebody sold a little bit. So because there aren't enough transactions, there isn't enough liquidity, you're not going to get real-time pricing on Yahoo Finance. That's why you can look it up on some of the other platforms, like if you're doing the trading. So when I look it up on my Questrade platform, I will get a more accurate depiction intraday, right? And again, it's going to track that net asset value. I'm not worried in this case with these ETFs. It's not like someone has to be buying it in order for me to sell. ETFs do have what's called a market maker. So they're going to hire a bank or a financial institution to basically provide that liquidity, right? To be able to make sure that if someone wants to buy, they can buy. If someone wants to sell, they can sell. So I'm not really worried about that. But we did talk a little bit about how with some of these new ETFs, there just isn't a lot of action, which means that you're not going to get these live, real-time, updated prices on sites like Yahoo Finance. Hopefully that answers that question. And then the last question here is, I'm going to come back to this in a future episode because Wealthica and Passive Lite. So these are two apps that I love that sync to my Questrade account, Wealthica and then Passive, which is a rebalancing. And they just signed a little agreement. I had tweeted at them and they were like, yeah, we actually, we just did it. So let me get my notifications here. Here it is. So basically they sent me to this a blog post, right? Which is they're saying here that they are now live, that Wealthica has now partnered with Passive. So this makes me really happy. I'm really thrilled that this is an integration. I haven't played with it. I haven't set it up on my own portfolio, but this is a way of basically like automating your portfolio so that we can come up with your ETFs and your percentages, and then it'll track your allocations in real time. So to me, this is going to make it easier for a lot of us like couch potato investors, rather than having to use my kind of crappy Excel spreadsheets. Okay, I won't. They're not crappy. They're beautiful. They are wonderful, beautiful, artful Excel spreadsheets, but they are very clunky and not everybody loves Excel. So that's why this is a big deal, that hopefully this is just going to make it even easier for people to be able to make their own portfolio and to make these intentional decisions about how to invest their money. So that's why it's a big deal for me. I think what I'll do is maybe, the folks from Passive, they've been great. I really love them. And maybe I'll be able to get them on the show to be able to do a little tutorial about like how to set up one of my model portfolios through Passive. I think that would be quite exciting. How's everybody feeling? Hopefully you're good. I've gone over the hour, so I'm ready to kind of call it a night. I'm sweating a little bit. I need to open a window here. But really, really happy here. I'll give it a moment to see if there are any other questions. I do see here, Onana, also the interest rate cut hurts the banks but should benefit the REITs. Also, government is helping out a lot. America, almost $4 trillion in total stimulus. This is why I don't know what's going to happen. Are the banks too big to fail? Probably. I have no idea what's going to happen. I do think it's going to get worse before it gets better. I'm worried that the government has been, very, very open about stimulus, but I'm worried that they've let all the animals out of the barn door, and I don't know how much is left for further stimulus. So we're going to see how this all plays out. Remember, nobody knows what's going to happen. I'm hearing a lot of optimism from wealthy people on the investment channels talking about a V-shaped recovery, that it's going to just bounce back up as quickly as it fell. I'm not so sure. I'm a little more pessimistic. I'm looking at the best case scenario. I'm looking at the worst case scenario, and I'm preparing myself for that worst case scenario. There is one last question here. If the Canadian banks might be badly hit, is it still safe to put money on high interest savings accounts? Small banks like Alterna or LBCD Digital. Yeah, so really, Gal, what you want to be aware of is this insurance, CDIC insurance. This is federal, so this is going to be for all the big banks. The credit unions are each going to be have their own provincial, so you're going to have like a DICO. DICO is the Deposit Insurance Corporation of Ontario for the credit unions, right? So we're in good shape here. But really what you want to do is make sure that any of your deposits are insured. So when it comes to some of these high interest savings accounts, you should be insured to a maximum of 100K per separately insured category. So this is basically per account. So your banks are going to be insured. This is a federal crown corporation, so it's insured by the government of Canada, up to 100K per account. This would be for the big banks, and this would be for the credit unions. I want to be clear that this applies to bank accounts, so checking savings, high interest savings accounts do count for this. This also applies to term deposits and GICs, guaranteed investment certificates. This is why we're allowed to call them guaranteed, because they are insured. This does not cover any investments. So RSPs, TFSAs, where you have stocks or bonds or any investments, this does not cover shares of RBC or TD or of banks. This is only about deposits inside of those bank accounts. I believe the provincial one, so this is like the Ontario one, this is going to be for all credit unions. These are actually insured a little bit higher, up to a 250K limit, right? Which is again per account. So what you want to do, if you're really worried about like a bank collapse and all this, then you do want to make sure that your deposits are insured, likely by CDIC or by your provincial deposit insurance corporation. And this way that even if the bank, like worst case scenario, absolutely goes under, your money is safe. I think we're far ways away from that. I don't think, I'm not expecting the banks to go under or run on the bank, any of that crazy stuff. I do think that, the economy is holding up, supply chains are holding up. We're dealing with this, I think, as best as we can. What I am worried about is that things could get worse. So obviously this is me having an abundance of caution and wanting to be able to really err on the side of caution. So that we are covered in any scenario. Okay, I think I'm gonna call it there. I feel like I covered the questions. If you're watching this on YouTube and you still have a question, leave it in the comments. Subscribe, hit the bell, get the notifications for when I come back on. I'm hoping to do this as a weekly thing. I think the tech is a little bit better this week. I've got high definition video. I've got a better microphone this time. I'm hoping that I'll be able to have guests to be able to cover different things. And thank you all for joining me. It means the world that people are listening and paying attention to this. Everybody have a wonderful week. Look after yourselves and your loved ones, and we'll see you next week. Bye-bye.